Stewart is a professional futures trader with 14 years experience, ranging from Merrill as a stock trader to making markets in options and expanding into futures at the Chicago Board of Trade. In 2011, Stewart began Chicago Stock Trading to offer his technical analysis and trading signals to subscribers. Today, he'll be showing us how trading volatility and pivot levels. Stewart, it's all yours.
Good morning, everybody, or good afternoon, depending on where you are. If everybody can hear me, just make sure that the sound is working correctly and the screen is showing good. Okay, so just to give you a really brief, okay. Yeah, so thanks for joining us today, and I'll try to do this quickly, but I appreciate everybody coming around today and being offered this webinar sponsored by Real Traders Webinar. So just to give you a brief analysis, I've been trading for 14 years. I started as a stock trader. I was trading for Merrill Lynch. We did high-frequency trading strategies, and that was in the beginning, and we transformed and started writing options, and we had an option writing program. I was one of the leaders in that. In our group, and what we did is we traded options on stocks that reported earnings on those days, and that was it was very successful. From there, we migrated into at the Chicago Board of Trade, became a broker, and my job was to fulfill orders and as well as manage trades and recommend trade signals and levels to my clients, and this developed into a daily technical analysis report that was originally just for my clients, but it was spread out into the brokerage firm and eventually into other brokers, and this is how Chicago Stock Trading came about. So just again, my name is Stewart. I'm from Chicago Stock Trading. Currently, I'm a professional full-time futures trader. I focus mostly on the E-mini, S&P, gold, and crude oil. I think that the markets are open, and you know, it doesn't matter where you are in the world. It is a public market, and as long as you have a plan and a strategy and your discipline, then it's all about, you know, building that consistency and developing yourself into that professional trader. So just as we begin here, the webinar we're going to review the market feel, use, and guidance of volatility windows combined with pivot levels. And there's two kinds, the intraday vol windows and the 6-month basis. And we're also going to review just some quick key technical patterns, head and shoulders, and island reversals if we get the chance. So all the time when we're trading, we have to know what our plan is, if we're day trading or if we're swing trading. If we're day trading, we always have to know what our plan and what our goals are. We have to have our objectives, what our maximum risk is for that day, so that if we, it's all about the opportunity factor. So we can get into a trade and let's say the original risk is $200 per contract. We want to take base hits, and if the market moves in our favor, that original risk, we're scaling out and reducing the exposure. So always using the market, we're using our own capital to enter risk into the market, and we're allowing the market to take that risk out for us, because not every trade is going to be a winner or a home run. And especially when you're day trading, you can't always go for that home run. So you have to build your day by taking those base hits and setting up those runners that you've reduced the exposure and gives the opportunity to see the market expand and bring you the home run. So that's why the holy grail is all about finding your own niche into the market. So everybody can give you all these different strategies and how they trade and all that, and it doesn't mean that you follow this person or that person or this person. You want to take things away from everybody and find something that you can feel comfortable with and you're confident. So it's all about as long as you have the confidence, you can be able to identify the trade signal and execute it. You know, one of the biggest parts is executing a trade. So you can have a plan, but execute it correctly. So as long as you have the confidence in that strategy, in that plan, you execute it, and you keep executing it no matter what, as long as the signals are correct. You keep executing it, and if the results are not good, then you have to take a step back and look at the strategy. If the results are good, it's all about when we have that confidence, we can have our patience and discipline and stay into the market. So we'll go forward here. The first thing we look at is pivot ranges. So I'm not a big fan of looking at a lot of technical indicators or having a bunch of lines and things on the chart. I think the biggest indicator is price and time, and we want to keep it as simple as possible always. But we do look at pivots, and we look at intraday pivots, and these are based off of the cash open that's on the open from the pits, and they help them identify support and resistance. And we plot the intraday pivots on 5 and 10-minute charts. 3-day pivots are based off of the last 3-day period, and we plot these on 30 to 60-minute charts, and we use dashed lines for that reference. And the 3-day pivots just identify that rolling support and resistance. The ranges are used because there's no way of telling where a specific pivot will hold the market. So the range, the wider the range, there's ways of identifying the widthness of the range. When the range is wide, there's more opportunity for chop. When the range is very tight in the pivot, that means the previous day had a very tight range. It was an indecisive market, so there's more room for volatility to expand. Volatility windows are based off of the pit open. The more volatile the open, the wider the range. The windows offer the market an area to trade within and see expansion when we break one side or the other. So we use time bases to identify that bias. Once we get that specific time period hold above the upper volatility window, this establishes a bullish bias. When we get a time period hold below the lower volatility window, it establishes a bearish bias. Once we have a bias established, the market can only reverse this bias. There can no longer, so for example, if we set up a bearish bias, we can't turn around and have a bullish bias for the day. The only thing that can take place is reversing that bearish bias and turning it into a reversal day. So in the next set of slides, we'll look at different examples. This is just to show how for example, a 10-minute chart looks like. We just using whatever indicators that you want to use, but the dashed lines are the pivots, you plug those in, and the solid lines are the volatility windows, which is derived from the cash open. So we know futures is practically a 24-hour market. It's not like stocks, so you come in 8:30, you know that's the open, and it closes at 3 p.m. In the futures market, it's practically almost 24 hours. There's goldback. So this is why the cash open is so important. We look at the cash open and we use that to identify volatility levels, and those are highlighted by, we plug them in as a solid lines, and they give us a reference point. So if the market comes down to the lower vol window, that's going to be a major area of support. And to establish a bearish bias, it needs to hold below that for 5 minutes. And the pivots, we just plug them in for our reference point, and that will give us either resistance or support depending on where price is. So again, when the market holds above the top of the window for half of the opening range, a bullish bias is established. Pressures to the upside and pullbacks are defended. When market holds below the lower volatility window, bearish bias is established and pressures to the downside. Rallies are sold with stops above the reversal window. So when the market establishes its bias and it retraces back to its reversal window, this is the last level of defense for that bias. A hold below reverses that bias, and it can use that range to have trapped people from that session and expanding it into the other side. So sometimes the market establishes a bias only to trap and get traders on the wrong side of the market. So these are different type of volatility windows. There's a constrained day, where it's just trading within the open or within the range, within the vol windows. There's a bull day when we break above the upper volatility window, we establish a bullish bias and we expand higher. There's a bull reversal when we establish the bullish bias only to lure longs in and then use them to liquidate the market. And then there's a confused day where we're just trading sideways. We establish a bias and we reverse, and then we just stick around by the open. A bear day is breaking the lower vol window and holding below to expand lower, and a bear reversal day is holding below the vol window to establish a bearish bias just enough to shake out longs and lure in shorts before squeezing higher. So this is an example of a bearish bias with a reversal. This was the open, cash open. It's highlighted in blue. We get a liquidation right off the open, and we fall right below the lower volatility window. So if we notice, the pivots are in these dashed lines, and the vol window is a solid line right in the middle. When the vol window and the pivots coincide, they offer a double area of support or resistance. In this case, the pivots coincide with the lower vol window, so it gave a double area of support for the market to hold. If it was unable to hold above that, it would be a lot worse of a move lower, because this is like kind of breaking through a, you want to look at it, like a big cement wall, and something's driving through it, and eventually when it breaks through to the other side is a clear open. So in this case, when we have both of them matching up, it was a double area of support. We get the market to break its lower volatility window. It holds enough just to establish a bearish bias. It shakes out longs from the Globex session, and it lures in shorts from the break of the Globex session, and then the market reverses and moves right through the cash open and holds above for 5 minutes. Cash open is 10 minutes on the S&P. We hold above for 5 minutes, we reverse that bearish bias, and then we get the expansion by taking shorts from the cash open under the vol window and back to the reversal window and expanding that 10 points higher, which Mr. Topstep actually talks about this a lot. This is one of their rules, and it's called the 10 handle rule. And you'll notice the S&P does like to move in 10 handle increments. For example, I've noticed that in gold, where we move in $10 increments. So here we are, 10 points off the lows. Again, when it's a bearish bias, rallies are supposed to be sold and defended, and that's what's taking place all throughout this squeeze. When it squeezes through the open, people who have been selling this cash open, they're getting squeezed out. And as it holds above, and because a lot of times the market can squeeze through a level only to trigger stops, like we see here in the Globex session, but not able to hold above the level. So it's all about price and time. How long, if the market is able to show that it can sustain above the cash open, then it's showing for the half of the time of the opening range, then it's reversed that bias. And what that pretty means, it's very common sense. It means that the market reversed above the cash open, shorts from that session are now trapped, and if it's not going to move any lower, if there's a bid now above the cash open, they're going to be forced to liquidate. And their forcement of being liquidated gives the room to expand higher. So sometimes we use the vol windows. So if we're looking at head fakes, if we have a big down day in the overnight, we'll look at the lower vol window to establish a bearish bias, just to get people lured in on the short side during the cash session and then look for a reversal. So you can look at vol windows like that if you're looking for head fakes to develop. And this is one with a bearish bias with a reversal. And in this case, since we had the pivots matching with the vol window, and we saw the market reverse, now this is based off of the intraday pivot on a 10-minute chart. The 3-day pivots we put them on hourly charts just to look at the overall picture and see where the support or resistance is for the trend. If we look at that particular day, this is the 3-day pivots and the dashed lines here. And we can see the market was having a flat top the day before, a few days before, but it broke above that right the prior day. And we traded all the way up to 1935. So the pivots were pretty much, this was the range. So what that tells you is that's a major area of support for that trend. Pullbacks into that give the trend support. And of course, to reverse that, I would have to take out the previous lows, which is this low here, right, from the June 4th, because it would show that this breakout above this range was unable to sustain, and it took out the previous low, so it's a failed breakout. In this case, we see these 3-day pivots. Right after this breakout above the 3-day range, the 3-day pivots are right at that top of that range, and they turn into support. So that, along with the intraday pivots over here, it created a much stronger level or range of support. And then that made it much more where you got the liquidation, shake out the longs, lure in the shorts, and then that gives you, the squeeze off the pivots and the 3-day pivots. So now we look at a bullish bias with a reversal. And this happened this Tuesday. If you guys remember, remember what happened on Tuesday, we made a new high by a tick for all-time highs by a tick, and what happened? We reversed and closed on the lows. So the way that was seen based off the vol windows and the pivots, when we came in that day, there was no pivot range. The pivot was about 53.5, and it did not have a range. So pivot was 53.5 with no range, and we can see there was no range because there's just one line at 53.5. And by not having a range, what that tells us is the prior day, the market was very tight. It had a very tight range, and it was very indecisive. So when there's no pivot range, it gives caution into the next day that the market is indecisive and there can be room to expand volatility and see sharper breaks, or at least an attempt to expand the previous range that it was in. And this is what we saw on that day is we had the no pivot, so that gave way for volatility to expand. But we started off, this is the blue shade is the cash open. So right off the open, we started off strong and we squeezed through, we rallied up into the upper vol window, we took a little pause and we broke through that. When the market broke through that, and held for 5 minutes, it establishes that bullish bias and gets longs aboard. We rally up and we take out the Sunday Globex low of 59.75 by a tick at 1960, turns into a failed auction, and the market, we see a small pullback and then a retracement back to the vol window, unable to hold at that level, so we fall right back into the cash open. So again, when it's a bullish bias, pull back into the cash open is the last level of major support for that bias, because when the market pulls back into the open, it gives buyers an area to buy the dip, because we have a bullish bias that day, and use a break over the open for the exit. And we can see we went about into almost a 1 hour or close to a 1 hour chop over here. We pulled back, rallied, attempted to rally, and then dropped back to testing the cash open lows, attempted to bounce again, and then we get the break below the cash open. When we break below the cash open, it squeezes out the longs from that session, right? Now, it doesn't mean that it's going to continue lower from that level. It's a matter of time. If the market is able to hold now below, because sometimes it can come to the reversal window, and this is the last level of defense for that bullish bias. This is where you want to look to buy it, and you have a very tight stop. The way this is traded, when we're individual traders, we use hard stops. The way funds use this is they're using more time, and that's why we use time with this, because they have larger capital and they're able to use more time stops than hard stops. So they can look to buy it at 1950 and not have a stop, and then use their stop as a 5. If it holds for 5 minutes, then they liquidate they reverse the market. So they would prevent, if the market clipped the reversal window and quickly came back above, being stopped out or clipped out. So it's all about that time. So the way we look at it is, as individual traders, we do have to use hard stops, and it's all about what the risk is. So if you're looking to buy down to 1950 and defend right on the open, you have a low risk, high opportunity setup, where if it continues that trend, you're looking at a retest of those session highs or a continuation of that bullish bias. If it fails and we break the reversal window, the longs from this cash session are stopped out. Now, if it's able to hold and sustain for half the opening range below the open, it reverses the intraday bias, and then we see the expansion lower, because then now the longs from that session are forced to be squeezed out and flushed out, and then we see another Mr. Top Step 10 handle where we expand from 1950 down to 1940. So if you look at right off the open, we rallied 10 handles and we pulled back to the open. There was an attempt to sustain that bullish bias. We reversed, and then we go into the expansion down. The other type of example is having a bullish bias into the close. The blue shade again is the open. We rallied off the open into the upper volatility window. The market is unable to break through during the cash open or during the cash session. We get a pullback right before the close into testing the opening range, and then a squeeze into the close. As the market was unable to take out the opening range and break lower, any shorts from that session, what are they left to do before the close? They're forced to cover, and then you get your squeeze through the upper volatility window, and it closes above. It establishes that bullish bias. So now going forward into the next day, it gives that spill effect where it can expand higher shorts that are still hanging on to their positions from that day. If we look at a bullish bias expansion, this is when the market, in this case, we see the market rally into the upper volatility window. We held just enough to establish that bullish bias, pull back into the pivots, turn into support, and then we get our expansion higher, again, another 10 handles. We look at a bullish bias with pivot resistance and a reversal window test. So we're looking at crude oil. We get a cash open, we get a rally through the upper volatility window, we establish the bullish bias, but if we notice the pivots there's a range of about 101.82 to 102.12, so that's some overhead resistance. And we can see we rallied all the way to the top of the range, and then we get a pullback to the vol window. We attempt to bounce and retest the highs off the vol window. It's not able to continue higher, so we get a flush down, squeezing out longs from that session, taking out the cash open, which triggers sell stops, and we fall right into the reversal window. So now remember, when we held above the upper vol window, we established that bullish bias for the day. So what that means is when the market comes down into its reversal window, that's the last level of defense for that bullish bias, and it gives an area for buyers to step in and defend it. And then again, if it's not able to hold, if it holds below its vol window or its reversal window for half of the opening range again, that's the time where it shows you it's unable to sustain that bullish bias and you get your expansion down. But here we get the test of the lower vol of the reversal window. It's not able to sustain below. Then we get the squeeze back up into retesting the session highs, retracement back to retesting this failed breakdown, and then a retest of the highs, and then we settle right where the cash open is. Now in this case, we did have the pivots right above the vol window, so that kept an over somewhat of a lid over the market. And if we look at where the 3-day pivots was for that day, this is the range, this is the bottom of that range, right at 102.05. So we can see the 3-day pivots coincided, and that was another area or another barrier of resistance. If we're able to get through that, the next level will be the middle of the 3-day pivot, which is 102.37, and then the top of the range, 102.65. Now you can see why is the 3-day pivots here above the market? It's because you can see we were trading above 103 a few days before, and then we sold down. So the breakdown turned the pivots to be lower, and the market began below the pivot. So the trend was turning bearish, and that's what, for the market to recover, it would need to recover above 102.80, which is top of the 3-day pivots, to reverse the short-term trend. Here's an example of a bearish bias expansion. We get the cash open where it's squeezed all the way up to 1876, takes out some overnight stops, and you can see here I had a trade that I bought the highs right into that cash open. So you can still buy the cash open or buy the highs of the market and still make money on the short side. It's not a matter of where you bought the market, where you sold it at. It's all a matter of risk management and identifying when you have one signal that comes up, you let it work, and if it fails, you go on to the next signal. You keep up with your system until you either you reach your profit targets or your goals for the day. So in this case, we can see right off the cash open, we fell right, we reversed slower, and we fell to test the lower volatility window right there at 1868 by highlighted by this horizontal line here, horizontal solid line, and then the first test of the lower vol window. It's not able to sustain under that, so we get the bounce into the cash open. Then we get a small pullback, and then another bounce out the lower vol window, because before they break the lower vol window, it wasn't, the sellers were not able to break on that first attempt. So what happens? The buyers embolden themselves and they push the market back up to retest that cash open. For here, I did have another sell signal based off of some tick charts that we use, but this is your retest of the open. So if you're looking at fading the market, you look at resistance based off that cash open. And we can see after the vol window test, we rallied, we retested the open. When the market was unable to break that cash open, then we get another pullback to the lower volatility window. And this time around, since they had already tested the open and failed to break through, there's more room to see buyers from that session bail on their positions, and that gives that weakness where, okay, we break the lower vol window, we establish a bearish bias, and again, we get the 10 handle move down right into 1858, and the intraday pivots are these dashed lines, and we fall right into the lower bottom end of the intraday pivot. We see a small bounce in attempt to cover shorts, and then settle right back at the lows as the market is unable to recover above the pivots, and it is a bearish bias. So into the close, what are traders left to do? They have to be forced out of their positions. If they're longs, they're going to end up having to liquidate, and that's why you see that expansion into the close as well. So if we look at a failed bear bias with a retest, again, you have your cash open, you have a break below the lower volatility window, just enough to establish a bearish bias, lure in shorts, shake out longs, then you get a recovery back above the vol window. It tests the reversal window, which is right against the session highs. It's unable to get above the first time. You see sellers of this bear bias come in and defend the market. You get another move down, which is 10. This is about 10 points here. So this was when volatility was more than what it is now. You get nicer moves. You know, you get a move from 1070 to 1120. It's a much nicer flow than what we've seen now at like 5, 10, 15 handle trading days, you know. So you can see we established the bearish bias. We rally into the cash open highs. They come in, sellers come in and defend that bearish bias, and you get that 10 handle pullback into retesting the lower vol window, and it's also retesting that head fake. When sellers are not able to continue the market and expand it below the lower volatility window, and what that shows is now we get the squeeze back through the opening range, and they're forced to have to liquidate because they were unable to expand. And pretty much it shows that shorts who came in below the lower volatility window are trapped. And when you get this retest, and when they don't see the market continue, where they're still trapped into the market short there, and when you get the squeeze through the session highs, they're squeezed out. Now, when the market holds above the reversal window, then it reverses that bearish bias, and whoever's left from that day, they're going to have to be forced to cover their positions because the market is going to sustain above the cash open, and it's not going to give them that opportunity to liquidate, and that gives the expansion higher. So in this case, we got an expansion up into the bottom of the intraday pivot, pull back to the reversal window, right into now the cash session highs turn into support as it was resistance, because we got the retest of the lows, and then the squeeze through to reverse the bias, and now this retest turned old resistance into support because you got the short squeeze, and now buyers are coming in to sustain prices at that level. So any shorts below that are trapped into the market, and they're forced to continue to be squeezed out. The first test of the reversal window, we get a squeeze new highs again into the pivots, where we're not able to, it finds the lid, and we fall back to the retesting the session highs, and then we see a small bounce where we attempt to rally, and then a shakedown right before the close, where again what happens? Since we reverse the bias, it's no longer a bearish bias. So you have to look at it as a reversal of a bearish bias, and you look to buy pullbacks. That's the whole point of this, is we're looking for flow. We're not using this to enter trades. You know, everybody has their own indicators and specific signals that you use. This is all to identify flow and bias, and where funds are coming in pushing the flow into that. Squeeze. So as a trader, you're looking at, you have the flow, it's a reversal bias. When you get that retest over there, it gives you an opportunity to defend, and your stop is right below these lows. So if the market takes out that range, that's your risk. If it's able to hold, all you're looking for is 1 times your original risk, where you scale out. So let's say you're risking 5 handles. The market moves up 5 handles, you're scaling out, and you can adjust your stop to break even. So this way, you have a free trade on. Or you can leave it original, and if you get stopped out, worst case scenario, you scratch the position. But the whole point of it is that we want to try to, we just don't want to see the market go straight up or straight down anytime, when we're getting for example, long. So we just want to, so if the market, we're seeing this sell down here and we're getting long, all we want to see is a bounce 1 times our original risk, just to give us that ebb and flow, to give us opportunity to scale out, and then it's up to the market to do the heavy lifting. So we used our risk to enter into the market, and then now the market has rewarded us, so it's up to the market. We use the market to take the risk out of our trade and let that do the heavy lifting to see if it can, expand. Okay, so if you're risking 5 handles here, you get that 1 time your risk. You take out your 5 points, put your stop at break even. So now, worst case scenario, you stopped out, you locked in 5. You can look on to the next trade. Remember, this is day trading. All we're looking for is base hits. We're not looking to hit home runs. This is not getting rich quick kind of schemes. It's, trading is a career. You do it. You look at the performance at the end of the year, at the end of the month, and it's all about consistency. So, for example, everybody has different risk tolerances. Somebody can be looking to do $200 a day, or somebody can be doing $1,000 a day. It doesn't matter how much you make a day. Even if you did $200 a day, that's $1,000 a week. That's about $4,000 a month average. So it sounds like a little per day, but if you're consistent, it's all about the long-term results. But in this case, we did see the bounce. One times your risk, you scale out, and then you can at that point put your stop right under this low. So you want to see when the market is unable to take out the lows, then you're going to get that short squeeze into the close. All shorts are pretty much forced to cover because it was unable to continue below that range, and then you get the move from 1075 all the way up to 1115. So this was when volatility was a little bit higher than what it is now. This is an example of a lower window test into a bull bias to get your cash open right into the pivots. You get your flush down into the lower volatility window, and then the reversal through the upper volatility window to establish a bullish bias into the close again. So, for example, you're coming into this day and you're looking at support, or you're looking at a level to buy the market at. There's two ways that you can do that. You can look at the lower volatility window for support, and that gives you a low risk buy level. So you can look to buy the pullback into the lower vol window, and then if it holds below, then it reverses that bias and it's close to the exit. But if the test of the lower vol window gives that area of support, to look for a signal. So we're always looking for a test of a level. Then based off of that test, we get our signal, and then we have our range that we can defend. That is a lot closer to the exit, and then by the time the market gets through the open, you're scaling out, and then when it holds above the upper vol window and establishes that bias, you're already scaling out of when the market established that bullish bias, and your position is, was at that lower vol window, so you're already in the money by much longer. So in this case, when the market holds this bullish bias above 1342, that's when everybody else is getting long. It doesn't give them much of an expansion higher here. We just traded sideways above that vol window, as opposed to if it was closer to the lower vol window, because that person was a little bit more aggressive and was anticipating a squeeze higher. They came in early, so they were able to defend the test of the lower vol window and then the squeeze through. This is a test of the lower vol window, followed by a test of the upper vol window, unable to break through the Globex highs. And then again, if you're looking at a short, you look at the test of the upper vol window. Based off that test, you use that as your range, and you look at a signal or a rejection off of that, and then that's your area to exit. But the test of the upper vol window gives the market or the bulls an area to try to see if they can sustain above. If they can, they have a bullish bias for the day. If they can't, you get the rejection down to the lower vol window. When it holds below again for 5 minutes, it establishes that bearish bias, and then we get the flush down, and then the short covering back into the lower vol window into the close. Here's our bullish bias. We pull back into the opening range. Our cash open. Again, over here, the pivots coincide with the lower vol window, so we know below the market there's a double layer of support. So if the market held below this lower vol window, it took out this range of support, it would be a lot more of a shake to people, because it was an unexpected move. It took out a major breach, and it gives more room to expand. In this case, we get our push off the open through the upper vol window. We establish the bullish bias. Again, we're looking at this as flow. So we're not going to look to buy the market when it establishes that bias. We're never, like me personally, like the way we look at it is we're never buying to highs or selling to lows. We're always, if we're looking to short the market, we're selling strength and buying weakness. And you're not going to be coming in. With that being said, it doesn't mean you sell into a rally and get in front of a train. It means you look at the train, you look at what the market is doing. If it's rallying, see where it rallies up to, and based off of its reaction to a certain price, and if it rejects that price, then you have a level of an area that, okay, the market rejected this price, I can use this as a signal. So in this case, we get the bullish bias established. We know the flow for the day has a bullish bias. To reverse it, it has to hold below the open for 5 minutes. We get a pullback into the open. It gives the last level of support for that bullish bias. It gives the an area for buyers to come in and step in to defend. They do so. Sellers are not able to break those cash open, and it's it's common sense. If the sell side can't take out the cash open lows, what happens? And if buyers come in and defend that, you get your bounce, and then into the close, shorts are squeezed out, because they if anybody came in trying to fade that, the market was unable to break that cash open. So that's how you can use that flow from the bias, because you're not gonna, if you have a bullish bias, you're not gonna be coming in trying to fade the lows and look for the cash open to break. If anything, you're gonna look for a buy and then the retest of the highs to fade if you're looking at a counter trend, or if you're being contrarian. Here's the bearish bias with bounce into the opening range. So this one was a bullish bias with pullback into the opening range. This one's a bearish bias. So we open, we fall down into the lower vol window, we breach it, we hold enough, enough to establish a bearish bias and flush out longs and lure in shorts. We have the pivots there that hold the first break, and then we get a squeeze into the cash open. So this squeeze into the cash open squeezes out small shorts who came in and started chasing these lows, and it also gives a bounce that retests the cash open, so it allows buyers their opportunity to try to see and to try to push the market through the cash open. And it also gives sellers, since this is a bearish bias, you're selling that bounce into the cash open and you're defending that. And again, if it recovers above that, then it's a reversal. But that's your low risk entry where you look at resistance because it's a bearish bias, so you look at rallies to be sold or you look at the weight of the market to be down. And then the retest of the cash open fails, we get on the next pullback, it takes out the lows, and then buyers, they see, they were unable to take out the cash open on their first attempt to bounce it here, so they get flushed out, and then we get another 10 handles down, and then consolidate a little bit, and then another 10 handles down into the close. This is just expansion, where when the market it's a trend day down, it's a bearish bias, so eventually it's going to end up closing on the lows as well, because if the market is unable to recover any longs from that day, they're going to have to force to liquidate. This is a constraint within the windows where we're just trading within the windows and we're not going anywhere. So those are what we just looked at, are the intraday pivots and vol windows. The next thing we'll look at is also 6-month pivots and vol windows, and these help in identifying macro bias, support, and resistance. And it's very good. Actually, this is perfect timing that you guys did this webinar, because June closes out the first half of the year. July starts out the second half of the year, and first 2 weeks is the opening range, the way we look at it. So, so Monday will be the last day, and then we start the second half of the year. So it's January through June, July through December. It's 2-week opening range that sets vol windows and pivots. Just like on a daily basis, during the day, we have the cash open, and based off that open, we have our vol windows. It's the same thing, because that's where the influx of orders come in, on the open and on closes. And it's the same thing when you're looking at quarters or when you're looking at halves. If we're looking at the first half of the year, the influx of orders comes in during the first 2 weeks. That's the open. It's setting the tone for the year or for the first half. So to establish a bias on a 6-month basis, it's half. What is it? It's half the time of the opening range. So if it's 2 weeks, what do we need to establish a bias? 1 week. So we'll look at this year. We have, if we're looking at gold, we started the year. Now we know gold the last year and a half has been in a downtrend. So it started the year on the lows, and it reversed right into, this was the 2-week range here, and then we get a run into the upper volatility window where it's unable to hold above the first time. The dashed lines here are the 6-month pivots. We get a pullback into the 6-month pivots, find support, and then they squeeze through the upper volatility window where we run up, squeeze all the way up to 1320 from 1275, but it holds enough for half the opening range, which establishes the bullish bias for the first half of the year. And what that means is when it's in the long trend, coming from a long trend last year, the downtrend, it's going to be harder for it to move higher. So this is more about squeezing out shorts, because we can see, even though gold established the bullish bias, it did rally up about 60 points to 1380, and it met major resistance based off last year's failure at 1434. So what happens? We get a pullback right into the volatility window. It's a major area of support because it gives buyers an area to defend. You get a bounce, and then a pullback right into the vol window again. It starts to tighten up, and then eventually, when it's unable to break higher and continue its bias, because the overall trend in gold has been down, so this was just a short-term reversal. This is from January. It squeezed out the shorts, and then now it's pulling back to look for testing downside support, right? So first support was the vol window, and then below the vol window, what's the next support? The pivots. And then we get the pullback into the 6-month pivots. In June, we held, and the market stabilized, and then it turned back, retested this trend line. We get a small pullback, an attempt to break lower, and then just squeeze through this range, where now we're just kind of trading sideways, and then the first half of the year closes. So it's still closing on the first half up. Okay, so at this point, the pressure is against these April highs to squeeze that out and then retest the March highs. But the second half of the year is going to be starting in July. the first 2 weeks is that opening range. This is the example showing the first half from January to June of 2014, where gold established the bullish bias, and then show you how it reacts to those volatility windows. So there's a lot of different ways to trade this. You know, you can again, when we're talking about the vol windows, if your overall trend is down, you have a bearish trend, and the market establishes a bullish bias. Sometimes that's used to lure in longs. You know, it's like head fake. So if your trend and if your bias is bearish, you can wait for the market to establish that a bullish bias, lure in the longs, and look to fade, you know, against major resistance levels. But this, you know, we're looking at just to show how volatility windows we can see on a 6-month basis. So we can trade this on using, you know, different vehicles if you're looking at option strategies and stuff like that. So based on options, you'd be, you know your 6-month basis is bullish, so you buy pullbacks into the 6-month pivot, and you buy pullbacks into the opening range. Again, if it holds below the opening range, you're exiting. But this is, you know, especially if you're writing options, when you have a bullish bias, if you get the pullback down, you can write some, you know, write the downside puts, or, you know, collect some, you know, thread. Even if it just stabilizes, you're collecting theta. But other than that, for futures trading, you know, the vehicle of trading, that's separate. That's all depending on risk tolerance or what the strategy is. You know, that can be, you know, identified. It's all a matter of what the levels are that you can trade off of, and based off those levels, you can look at the vehicle that you want to use to enter into the market. The next example is, again, the Japanese yen also in 2013 had a bearish bias, but it started the year on the lows, and we reversed through the upper volatility window. It held above to establish a bullish bias, but this bias is only being used to hold shorts into the market since last year was down, and now is just stabilizing. So we established the bullish bias, we pulled back into the opening, into the vol window, and then it starts to go sideways, unable to break these February highs. You get the flush down into the opening range, another attempt to rally, a flush down into the pivots, another reversal right back to these highs, and then a retest of this breakdown where it's fine support and it turns back up, back to the neckline here, and now we're seeing the market get tighter. But what's trying to happen is you have an inverted head and shoulders here, and we're trying to expand that up. So if you're looking at an expansion, is you take that range from this high to this low, and you're expanding that up. But again, vol window, bullish bias, 6-month pivot support. Bullish bias for the first half, example in the S&P 500, this is the first half of 2013, established the bullish bias, pulled back to the vol window, and we expanded that bullish bias into June, and then we get the pullback in June to close out the first half. The second half, we rallied through the upper vol window, couldn't establish that bias the first time, pulled into the 6-month pivots, find support. And again, for, you know, long term, you can look at, you know, for position trading, you know, this is, you're looking at the flow bar. You get the test of the support into the 6-month pivots, and then the squeeze through the vol window, establish the bullish bias, and another test of your 6-month pivots, and then continuation of that bias, expansion into the end of the year, where it expands from 1660 up to 1840. So this is what's happened this year. The first 2 weeks in January is highlighted in blue. We had a sideways open chop. We get a liquidation down, which was the first time in 2 years the market liquidated it down to establish a bearish bias. So held below the lower volatility window here, just enough to establish a bearish bias, lured in shorts. We get the flush down to 1730, hits a major trend line from last year's lows, and then we get a sharp reversal through the vol window and through the cash open here, or the opening of the year. It takes out 1844, which is where the break started, and it squeezes out those shorts. So this is how the market used, or was able to continue higher the first half of the year, is by setting up this bear trap early on, breaking below the vol window, establishing that bearish bias, getting everybody short, and using them as a fuel to squeeze it back to 1844. When the market recovered above 1844, it showed a V reversal, right? So at this point, the longer it holds above 1840, the more any shorts below 1840 are going to have to be forced to get out, because the market turns resistance into support, and now you get the expansion higher. So the 6-month, we get the bearish bias, and then we get the squeeze through the reversal window. We get it sideways consolidation, and then the squeeze through. We hold above just long enough to establish the reversal, and then now, since the first half of the year is a reversal bias, it's no longer a bearish bias. Pullbacks are defended. You get the pullback into the 6-month pivots, another attempt to, into new highs where it saw profit taking, shakes down right into retesting the top of this range. That turns into a failed breakdown, and then you get your rally back to your highs of the year. May was much tighter, where we made a new high at 1898. We pulled back. We retested this May low right here at 1854, and it held. So if it took out this May low, that means this new high in May was a failed breakdown, and it would see a retest of this April low. But it held in the middle of May, and by holding there and turning higher, it squeezed out the short side. And by taking out this high, all the shorts who try to, they're forced to be squeezed out, and that's why then we get this breakout over the 3-month range, and it's, rides the upper Bollinger Band, and it reaches a fib level at 76.4%, which is where we are now, 1956. So also, how you look, if you want to look at how you get a target at 1950, anytime you're looking at a reversal, for example, your reversal is 1844 down to 1732. That's a 112-point range. If the market recovers above 1844, you have a V-shaped reversal. You take that 112-point range, you add it to 1844, and that gives you an expansion target where you can see the market expand that V. And then so you take this range, you add it to the top, you add 112 to 1844, as you get your 1955 or 56. And that's where we are right now, is where we hit 1955 on the June contract. When we rolled over into September, we saw a pullback into the June lows. We held and we turned back as the September turned into the front month. Now that one is into its 1956 level. And as long as it holds this June low, the pressure is against the short sides to try to continue higher. If it breaks below this June low, what do you have? You have a failed breakout and a double top. And then you would be looking at a retracement back to the May range, the breakout for support. And this is the current ES weekly. How we're looking at those fib levels is we're taking the last major low, which was made in 2013, off that break at 1550, up to the 2013 high, down to the 1732 low. That gives you your 76.4, fib expansion levels, because these are uncharted territories. The market's never been at 1950, 2000. So how do we know levels of where the market can get to? Is by having fib extension levels and using, ranges of when the market reverses, falls down and recovers, then you use that to expand higher. But here we are, 76.4%. The next major fib, if we expand this 100% up, is 2025. And I'd be looking at hitting that top level. But you have your series of higher lows. So long as that holds, the trend is up. Once that series of higher lows breaks, then you have a reversal in the trend, and it's going to be rallies that are going to be looked to be faded. But at this point, shorts is still going against, it's still going against momentum, so it's still aggressive. But we're going to look at July starts the second half of the year. The first 2 weeks will establish the vol windows for the second half of the year. And I have an offer where you guys can, sign up for the vol windows for the next 2 weeks for free, and after that you can decide if you want to keep them. But after the 2 weeks, these 6-month vol windows will be issued, and we'll know what they are for July. So based on how the volatility is, we'll have vol windows. So if we have, for example, a vol window at 1975 by 1800, the market holds above 1975, it establishes that bullish bias. We may look to as a head fake, as a capitulation of where it lures in all longs right there at the top, and then we're looking at fading that. That's if you want to be a contrarian. On the other hand, if you want to go with the trend, you buy pullbacks into the lower vol window or into support. So we're running out of time here. I'm not going to be we're running out of time, but technical patterns I want to look at was these are basic. Everybody knows these patterns, and there's different ways of trading them. Most people trade these patterns. Most patterns are lagging. It's just a flow of what is going on, the psychology of the market. Indicators are lagging. Moving averages are lagging. When you're getting into a short, you're fading into a resistance level, and by the time the indicator goes in your favor, you're already looking to take profits. So you should be trading ahead of what the indicators do. In this case, how we trade head and shoulders, to get the logic of a head and shoulders, it's not the pattern that we want to trade. We just want to know what the logic is behind it. And if you understand the logic behind it, it shows you the psychology of what's taking place. So here we have a first peak. We hit 1880, and then we get a pullback. This peak and the pullback is, when we get this pullback, shorts are coming in and they're fading that. They're getting short. When the market is unable to break lower, and then we get a continuation of the trend into new highs, all those early shorts from the first peak, they just got squeezed out. And since the market took out that high, we also have those breakout buyers, and people are coming in long now because it broke out. So it's up to the market. It takes out the first peak, the first previous high. Now it squeezes out the shorts. It's up to the market to see if it can sustain and attract new buyers, right? It doesn't when it's a head and shoulders, or when this is how you identify it. When it's a failed breakout, you get a reversal back down below the previous low prior to that high. When you get that reversal back down, that shows you that it was unable to sustain those new highs, and it was a failed breakout. So now you look at this break below these lows shook out the long side. So you get this head being done on shorts being squeezed out. They got squeezed out. Then the reversal down squeezes out the longs. So you know there's distribution taking place here, and you have a failed breakdown. And people coming in as it takes out this low, they're coming in shorting this. You're not going to look to short into the lows again. You look for a bounce into retesting that failed new high. And that develops your right shoulder. Now, it doesn't mean that it's going to hold and turn into a head and shoulders, but you have to be proactive. And if you're looking at, you look at your signal where the market puts in a new high and rejects that, your retest gives, it's logical. You look at the retest gives buyers the opportunity to try to push through where it failed. And if they're unable to do so, the market's going to come back down and test the neckline. And if it breaks the neckline, what do? You take the range from the neckline to the head, and you subtract that lower, and you get your target levels. But in this, if you're looking at getting into, the way I get into these trades is I look at this pattern where you have the failed breakdown and the retest to give you. So when you're fading this, you want to fade the rally into the retest. So by the time it's coming into this neckline, you're covering as everybody else is getting short, and then now you can put your stop back to the right shoulder. So if it comes out and takes the right shoulder, you're out. But if it expands, that's when the home run comes in, because not every pattern is going to expand. You want to let the retail and everybody else chase the market below the neckline. And then you can even see, even within, head and shoulders patterns, they're done on all time frames, 1 minute daily. It's a psychology or movement of the market. You can see even within this larger head and shoulders pattern, if you look at the right shoulder, there's another mini head and shoulders, because you have a first high, a higher high, a pullback, and then a retest here within that right shoulder. And then this is how it looks when you get the pullback. So this is the retest of the open. When it's unable to push through, it falls back to the neckline. So now what happens? Longs are going to be, as long as it holds below this neckline, longs are forced to be liquidated out. You take this range, that gives you your downside target level. And you can see this is your head and shoulders, and even within the right shoulders is another head and shoulders pattern. And then this is your range where you get your retest, pullback, and then expansion just completed it. And now since we're below this neckline, we're expanding down to 1850, and then this is your expansion down into 1850. You get the bounce and then down. So, and then you can see right when we completed that head and shoulders, the market quickly went bid, and it didn't spend no time finding buyers reversing it back up. That's so much of a, the flow of this first half of the year has been a reversal bias, right? So the flow is every pullback is being used as opportunity to cover shorts and to hurry up and get long into the market. Another head and shoulders pattern is right before the debt downgrade, you have your 1373 high, pullback, retest of that high, and then you have your distribution. You're looking at your downside expansion right into 1100. If it breaks that neckline, you get your chase down. Again, your entry level is the right shoulder. By the time it's breaking the neckline, you're holding. So these are head and shoulders that work. Okay, everybody can show you patterns that work. So we also need to look at patterns that don't work, and I'll show you that. This is another example of head and shoulders. You have your higher high that's rejected down, and the way to identify a head is by seeing when the market makes a new high and it comes down and take out that previous low. It just shows you that it shook out the longs and it set up a failed breakdown. So now the retest gives you your level to short or resistance, and that's your right shoulder. If it comes down to the neckline and breaks that, it gives you your target of 1135, and this is where we get the target of 1135. And in this case, this is when the flash crash occurred. And when we came down to 1135, that's when the systems failed, and we ended up falling further to 1060. So you can never predict when the systems fail, when the computers crash, or anything like that. But we can see signs and signals that the market, or caution levels, that the market can give us beforehand. And this head and shoulders was that caution or warning sign, because it showed a failed breakout in distribution, and then when we turned lower, there was kind of a rush to get out and a little bit of a fear, and then you get that flush down. This is what the intraday flash crash looked like. During the day, you had very narrow pivot that day, which gave way for volatility. You get your open, it goes through the upper vol window to establish a bullish bias, it lures in longs, and then you get your reversal below the open, and reverses the bias. So now, not only did it lure in longs from that session, it's got those longs to use to sell, and then you get your move down right here into 1130, which completed the head and shoulders target, and then you can see from 1130 to 1060 was the flash crash, and then where do we bounce right into that 1130 level where we stabilize. Okay, this is a head and shoulders failure where you break the neckline and then a quick reversal to take out the head, squeeze out. So again, you're not fading below the neckline, you're fading, or we're looking to fade the right shoulder. So by the time this is, if people who are coming in selling down here, your stop has to be above the head, and that's a large risk. When we're trading futures or anything, it's leverage. It's all about what the risk is on that trade. If you're selling it at 21.50 and stopping above 23.50, you need the market to complete that head and shoulders, and that's much harder to do than if you're defending resistance and looking for a pullback into that neckline. If you're selling this right shoulder, your risk is a lot less. Let's say it's 100 points here, so you're already covering 100 points down, and then if it expands, you get the home run. If it doesn't, you're stopped out at your entry level. That's too bad. Move on to the next one, I know I did this a little bit quickly because it's much longer than usually is, and we're running out of time here. But I really appreciate anybody who's stuck around, and I wish we had more time where I can go through this more with you. If you did want to get the vol windows, I'm offering it for the Real Traders webinar for the next 2 weeks. You guys can sign up. It's free. Comes with daily S&P analysis, volatility windows on ES, CL, GC, golds, bonds, and the euro. And then after the 2 weeks, if you decide to sign up, that's when the 6-month vol windows will be based off of that 2-week opening range. So that's one thing that we do. The other thing that we have is we do have the other program where we do day trading signals, where we have a room trading live throughout the room with a live screen share. You can see the actual signals on our screens, and we have our analysis the night before, and then the chat room where we'll put our orders in, and then the flow with where the signals come in on day trades and swing trades. I don't know if we can have time for any questions. If I can look at the question. Okay, thank you. For the second half, the last question is there a silver futures? Is there a bullish bias for the second half? Well, the second half of the year hasn't started yet. It starts in July, and before establishing that bias, we need to look at the opening range, which is the first 2 weeks of that opening range for the second half of the year. Once we get that, we get the volatility windows. Then it's up to the vol windows. If the market rallies through the upper volatility window and establishes that bullish bias, you have that bullish bias. So what I would look to do is if it establishes that bias, then I know the bias for the second half of the year is bullish, so I would look at buying pullbacks. When we get the pullbacks down into the upper vol window or to the pivots or to the opening range, that gives me an area to defend. It gives me just the idea of what the flow is, and if it falls down into the reversal window, that's the last level of major defense, and it's a much lower risk. I always like to, get into the trades where, I'm buying weakness, and I know, I'm buying that weakness, and I'm not looking for the market to break through the, we're looking at that ebb and flow, just that bounce, give it that opportunity to scale out, and then let the market do the heavy lifting to see if it can continue the other way. Yeah, we always use for the S&P. What's the open in the S&P? It's when New York opens at 8:30 or 9:30 in New York, and then in Chicago it's at 8:30. So we're here at the Chicago Board of Trade where the futures trade, and over here it's at 8:30 a.m. The first 10 minutes is the influx of orders, but that's the cash open. Now there's other people who use different times for their opening ranges. Some people use 1 minute, 5 minutes, 15. But that's the 8:30, 9:30, that's your cash open. And based off that cash open, and you'll notice, haven't you noticed, a lot of times your open sets the tone for the day, right? So sometimes you'll notice the open are the lows of the day or the highs of the day. And other times when the market runs off the open and it comes back and it takes out the opening lows, what does it do? It just set up a reversal for that day. But the vol windows give you those areas outside of the market where the market can rally and test and either reject or set up a trap where it establishes the bias and comes back to the open and then lures in more longs, and then when it breaks the open, that's when you get the reversal, you know. So the vol windows only give us those areas of where we can, you know, set traps into the market, or again, if we hold above the vol window, it shows that it's not a trap because it's able to sustain, and that's where you get your expansion of, or your trend, you know, because not every day you come in, you see the market go up or down. Not majority of the time, know what our risk is getting into the trade. We're using that ebb and flow into those sideways moves, you know, buying support, defending resistance, and rescaling out and allowing the market to reduce our exposure. And then it's up to the market to see, we let the heavy lifting into the market to try to expand that range. If it wants to break out and start a trend or continue a trend, then those are the runners that go along with that, or that take place with that. Yeah, I'm sorry, I didn't see these questions as we were doing the webinar. I was looking at the presentation, and I didn't see, you know, this one. But if you'd like, we'll have more volatility windows, if you know, more information in the future. Again, I'd like to thank you for joining us today and for sticking around on this Saturday for this webinar. And I like to thank Mr. Topstep and Real Traders Webinar for sponsoring us today.
Thank you, Stewart. That was an unbelievable presentation. Thank you so much. And again, we also would like to give a shout out to Mr. Topstep and Danny Riley for hooking us up with Stewart and having him come in. And also, guys, just to remind you, if you would like to check out Stewart's offer, you can see the link in the chat box, which is realtraderswebinar.com/Chicago stock.